Okay, so thank you for joining my channel, and do not forget to subscribe, like and comment. So I am here to show you or teach you financial instrument under financial reporting. I'm here to teach you financial instrument. Now financial instrument is governed by an accounting standard. So we have the IAS 32, which deals with the presentation, and we have IFRS 7, which deals with the disclosure of financial instrument. So we have the presentation and we have the disclosure of financial instrument. Now when we talk of financial instruments is any contract that gives rise to a financial asset of one entity and a financial liability or equity to another entity. That is very simple. Financial instrument is any contract. So what you have to know first is that financial instrument is a contract. So any contract that gives rise to a financial asset of one entity and a financial liability or equity to another. Financial asset and financial liability. We will go there soon. So any contract that gives rise to a financial asset, in the sense that there is an asset, or let's say we are receiving an economic benefit, and at the same time it gives a financial liability. So we all know the double entry principle. Debit the giver, credit the receiver. So when we talk of a financial asset, so let's say we have entered into a contract with a different party, and that party is to offer us a $10,000. So that $10,000 becomes an asset to us, because what? Because we are receiving, and the other 10,000 which that company is also issuing to us, that has become an asset here. It becomes a liability, because there is an economic outflow. So any contract that gives asset and liability is a financial instrument. These are just the theory aspect that they won't bother to even ask you. So another financial liability, per the explanation, we have financial asset. So financial asset. Now the financial asset, another financial asset, we have, let's see, we have cash. 1, 2, we have an equity instrument. 3, we also have a contractual right. To receive cash or another financial asset. Remember, the definition is saying that it's any contract. So now under financial asset, a contractual right to receive a cash or another financial asset will all fall under financial asset. They will all fall under financial asset. So we can also have trade receivables. All of them fall under the financial asset. All of them fall under the financial asset. You also have options. These are just outline, or these are just the introduction. The main options and these things are going to be taught very well in financial management. So in financial reporting, it is just a surface or an introduction to equity finance. Let me put it that way. Equity finance, or the cost of capital, is just an intro. So we have options. Options will be taught in financial management, so I don't have to stress on that. Financial reporting doesn't deal with options. All right. Now we have financial liability. Financial liability, and it is very simple. So since that this is financial asset, the opposite is going to be a financial liability. So here we have a contractual right to receive cash. So the first thing, a contractual right to pay or deliver cash to an entity. That's all. We have trade payables. Just the opposite, we have debentures. And mind you, debentures will be taught in financial management. Debenture is simply a long-term loan. That's all you need to know about debentures. A long-term loan, debenture. We also have redeemable preference shares. They all fall under financial liability. These preference shares and debentures will be taught well in financial management. They will be taught well. As to how they are part of financial liability, you doesn't need to know them in your financial reporting. Okay, so I will start with the financial liabilities. So we have initial recognition. So initial recognition of a financial liability. We have initial recognition, and now this is usually the net proceed of the cash received less any cost of issuing the liability. The initial recognition of a financial liability is equal to the net proceeds of cash received less any cost of issuing the liability. That's the initial recognition of a financial liability. So let's say there is an issue. Remember, liability is when there is an economic benefit leaving the entity. So the very moment you hear issue, it means it is a financial liability. So the keyword here is issue. The very moment you hear this issue, it means that it is a financial liability. The very moment you hear issue, because there is an economic benefit leaving the company. So issue means it is a financial liability. So the initial recognition of a financial liability is that after the initial or the net proceed of the cash received, you just subtract the cost of issuing the financial liabilities. There are some companies that let's say when they issue a financial liability, it takes a third party or an agent or whatever to do or to intermediate between the company and the shareholders or anybody interested in the financial liability. Okay, so the cost incurred in issuing. So in most questions or in most cases, let's say Keiko issued a 20,000 loan to his shareholders. Okay, incurring a cost of 5,000. So the first thing you need to do is to recognize the financial liability, and the recognition is initial recognition or the net proceed, of the cash received at any cost of issuing. So we issued 20,000 loan notes. We issued 20,000 loan notes. Are you getting me? So now the 20,000 will come here, less any cost of incurring. Less any cost of issuing. Now the cost of issuing is also 5,000. So this minus the 5,000. So you recognize the 15,000 as your financial liability. You recognize your 15,000 as your financial liability. Now we have subsequent measurement. Okay, we have subsequent measurement, and this subsequent measurement will continue from where you ended the initial recognition. It will continue from where you ended the initial recognition. So now the subsequent measurement is under an amortized cost. So amortized cost. So under the amortized cost, the subsequent measurement is here. Remember, subsequent. So meaning that where you ended the initial recognition is where you start from the subsequent measurement. So we have the initial value, and so in this case our initial value will be our initial recognition. Always the initial value is the initial recognition. So in this case it is our 15,000 over here. That is under the amortized cost. Now with the initial value, you add it. You add the initial value to the effective interest rate. Then you subtract it from your interest paid. That's all under the subsequent measurement. So you have your initial value, you have your effective interest rate, then you have your interest paid. So this is initial recognition. So after lessen your transaction cost or lessen any cost incurred in issuing the liability from the actual liability you incurred, it will come under the amortized cost as 15,000. Then you add, so this 15,000, you add your effective interest rate, which will always be in the question. Effective interest rate and the interest paid. The effective interest rate, you add it, and the interest paid, you subtract it. And the effective interest rate, maybe let's say the effective interest rate is 5%. And maybe so the effective interest rate is 5%, meaning that it will always be this 5%, multiplying this value over here. The effective rate, they will give it to you in the question that effective rate is 5%. So you just bring it on top of the effective rate. So you always multiply the percentage by the initial value. Now we have interest paid. This interest paid is very confusing because in the question here they said Keiko issued a 20,000 loan note. So in the question, a typical question would be issued a 2% 20,000 loan note. If the question says that issued a 2% 20,000 loan note, meaning that the interest you are going to pay is 2% on the 20,000, not on the 15,000. Again, the question will always tell you that they issued a certain percentage of a certain amount loan to 8 shareholders at an effective interest rate of, let's say, 5%. So the percentage before the total amount of the financial instrument they issued, that percentage is the interest paid. So 2% 20,000 loan note means that the interest paid is equal to the 2% multiplying the 20,000. So the interest you are going to pay is 40. The interest you are going to pay is 40. But the effective interest rate at the end of the question is always multiplied by this initial value, or it is multiplied by any figure here on the left side. So since this is our effective interest rate of 40, you will pay 40 throughout. But it is supposed to be a negative. Interest paid, you see there's a minus sign here. So it's supposed to be negative, so negative 40. And this will run through. So the question tells you to stop. Normally it is always 2 years or 3 years. So let's do it 3 years. Now we have our balance carry forward. So you add it. You add them. Then you drag downwards. Okay. So always, this is how you set up your workings. Your initial value, effective interest rate, the interest paid. So effective interest rate is add, interest paid is minus, then balance carry forward. So this balance carry forward here, 15710, will become the initial recognition in the next year. So this will be year 1, here will be year 2. So in the following year, the initial recognition is the balance carry forward from the previous year. So 15710. And remember, I told you that the effective interest rate is always multiplied by the figure beside here. So now the effective interest rate is also 5%. So 5% multiplying the figure here. Then you bring your 40 interest paid. That's 2% of your 20,000. And this is your balance carry forward. So your balance carry forward here will become your initial value here. So you bring the same thing here. You apply your 5% to the initial value. Your 40 is always there. So here is your balance carry forward. So the year they tell you. So this is the amortized cost and this is the initial recognition. So financial instrument is very, very simple. The effective interest rate will always be different from the interest paid. The effective interest rate will always be different from the interest paid. Bear that in mind. I told you that the interest paid is on the full financial liability or financial whatever amount, full amount. So the 20,000, that's the 2% on the 20,000. Are you getting me? Yeah. Now your effective interest rate, they will always give it to you as well. Now we have our financial asset. financial asset. Financial asset is just the opposite of financial liability. The financial asset is always the opposite of financial liability. So is recognizing financial asset is still the net proceed of the cash that you paid less any transaction cost. Liability is cash received. Asset is cash paid less any transaction cost. You get it? Subsequent measurement under amortized cost. You set up your workings this way: initial value, effective interest rate minus your interest paid, then you bring your balance carry forward. This is your workings. That's all. So I will try and solve a question with you so that you understand it very well, right? I will solve a question with you. So we also have convertibles. We have convertibles. So with the convertibles, I will touch on them, but you need a question. So we have convertibles. So this convertible, as the name implies, convertible, meaning that it can be converted. It can be converted. It can be converted to either a liability, not asset, or equity, not asset, either a liability or equity. Why am I saying this? Convertible, when you get into an agreement with the company that, okay, I will give you this amount of money in a form of loan, but this loan that I'm giving to you is convertible, meaning that me giving you the loan, maybe I have given you a rate of 2%. So let's say I gave you a loan of 5,000, a loan of 50,000, let's say 50,000, and I told you that the rate is 2%. So meaning that at the end of the year, let's say I gave it to you for 1 year. So at the end of the year, it is going to be 1 plus the interest rate multiplying the 50,000. So at the end of the year, we are going to receive 51,000. At the end of the year, we are going to receive 51,000 if we take it as a liability. That is the liability part. But the company says that you have the ability to convert it, so you can choose to be a shareholder also, or you can take your money back at the end of the first year where the loan lasts. And so you have to wait. So maybe the time you gave the loan out, their share was 0.5, right? Their share value was 0.5. Now at the end of the year, when you wanted to take your 51,000, their share price was $2 per share. So what are you going to do? Instead of taking the 51,000, you convert this 50,000 into shares. So you just multiply your 2 with the 50, 100,000. So every rational human being will want to convert the loan they gave out into shares. So 100,000 shares. That's very simple. But in a case whereby the share may be decreased to 0.4, you have 20,000. So you just take your 51,000. That's all about the convertibles. You have the ability to whether change it into shares or take your money back, as the contract said. So that's all about convertibles. We also have debt instrument. They will be touched on in financial management. So the equity instrument, this thing, the equity instrument is measured at either, measured at either fair value through profit and loss P and L, or fair value through other comprehensive income. That's the measurement of the equity. You measure it at either fair value through profit and loss or fair value through other comprehensive income. So the fair value through profit and loss is the default category for every equity investment. So any transaction costs associated with the purchase of this investment are expensed in the profit and loss. You see, in the financial liability, you just less it, but here any transaction cost will be expensed. Transaction cost will be expensed. Are you getting me? And are not included within the initial value of the asset. So transaction costs are not included. They are not included. The investments are then revalued to fair value at each year end, with any gain or loss being shown in the profit or loss. That's all. That's all. So the only difference from the other comprehensive income is that the transaction costs are capitalized. Transaction costs are capitalized. And when we talk of other comprehensive income, we are talking about revaluation. So here they are revalued at the end of every year. That's the financial instrument. The equity is revalued. Here they are not revalued. Here under profit and loss, they are not revalued. Sorry. They are both revalued. But here the profit or loss will go to the profit or loss. Here increase or decrease will go to the other comprehensive income. So you have your financial liability, you have your financial asset over here. So financial asset, financial liability. I tag on the financial liability because financial liability is just the direct opposite of the financial asset, right? The opposite of financial asset. So I have a question that I would like to solve with you guys. Okay. So this is under convertibles. So here is under convertibles. Here is under convertibles. Now, Late Law issued a $10 million convertible loan note on October 1st, 20x2 that carry a nominal coupon interest rate of 5% per annum and are redeemable on 1st October 20x5. So from 1st October 20x2 to 1st October 20x5 is 3 years. It's 3 years. Are you getting me? So now let us continue. The question says that a similar loan note without the conversion option would have required Late Law to pay an interest rate of 8%. Relevant discount rates are shown below. Relevant interest rates are shown below by Late Law. Now, what you need to do first is that convertible. In order to solve for convertible, you have to first know the present values of the future cash flow. The present value of the future cash flow. And remember that convertible consists of equity and liability. It consists of equity and liability, meaning that the very moment you hear convertible, over here, you are going to find your equity and your liability. You are going to find your equity and your liability. So now, in order to find your equity and your liability, you need the present value of the future cash flow. The present value of the future cash flows of the convertible. Now the convertible is having a 3 year. So from 20x2 to 20x3 is 1 year. So 20x3, we have 20x4, then we have 20x5. Please set up your workings like I have done it. So year. Now we have our cash flows. Remember, it is the present value of the future cash flow. We have our cash flow. Now our cash flow is the 5% multiplying the 10 million. So let me ignore the 3 zeros. So let's do 10,000. We have 500. We have 500. That is the cash flows. This 10 million is constant. But at the end of every year, remember I said it in the financial liabilities that the interest paid is the rate attached to the whole amount. So here the interest rate is 5%. So at the end of every year, there is a cash flow of 500. At the end of every year. So at the end of year 1, there was a 500. At the end of year 2, there will be an interest of another 500. But at the end of year 3, where the person is to recover all the convertible loans, is the 10 million, that's the 10,000 plus 500. Do you understand? Okay, so the reason why the last year is always the full amount, that's the 10 million plus the rate, is that when I give you a loan for 3 years, I'm not going to reclaim all the loan after year 1, year 2, year 3. My 10 million together with my interest will be taken in year 3, the final year. So in year 1, there's an interest of 500. In year 2, there's an interest of 500. But in year 3, that the loan is coming to an end, you are not going to give me 500. You are going to give me my money plus the interest. So that's why we have our 10,500. So always the first years are the interest, and the last year is the interest plus the par value of the loan. Are you getting me? So that's the cash flow. Then we have our discount factors or our discount rate. So we have our 0.93, 0.86, 0.79. So we are actually using the 8% discount rate. Why are we using the 8% discount rate? Because the interest rate of 5% was used as our loan fee, was used to get our interest here. So this 5%, the 5% over here was used as the interest rate to get our interest of this 500. So for us to get a present value, we use the 8%. The question said that a similar loan note without the conversion option would have required late law to pay an interest rate of 8%. So we discount it with this 8%. So we have our discounted cash flow. So the funny thing is that this is in present value terms. The loan will be redeemed at the end of 3 years. So at the end of the 3 years, this is what we are expecting to receive. But we want to know how things stand as at now. So we have to discount it to present value terms. So we just multiply it, the discount factor, by the cash flows or the interest rate. So this multiplying this, so 465, you drag it to the last year. Very simple. Now what you need to do is to add it. We have 9190. So this is our 9190. And what is our proceed? Remember this, we are working on the liability, because the interest, whatever thing that you are doing is liability. It's not equity, it's liability. So liability, that's all. And now the total liability was 10 million. Ignore 10 zeros, so 10,000. Our total liability, our total loan or proceed, let's do proceed, was 10,000. That's the total proceed. And now total proceed was 10,000, and our liability that we got from discounting and doing everything was 9,190. So what is the equity? The equity is the balancing figure. So the total proceed minus the liability, 810. So this 810 is your equity. That is the balancing figure. That's all. So the only time, or the only way to find your equity, the only way to find your equity, the only way to find your equity is after finding your liability, you subtract it from the total proceed. The loan they issued, just take note, they issued 10 million notes, that's the total proceed. Okay, so you get your equity. Now you set up your workings. Initial recognition. You have your effective interest rate. You have your interest paid. Then you have your balance carry forward. Your initial recognition of the liability is this. This equity, you have no business with that, you are done. So your liability, the initial recognition, is this. Effective interest rate, they gave it to us in our question, 8%. So the 8% multiplying 9190. You subtract your interest paid. Our interest paid is 500. The 5% multiplying the 10 million. So our interest rate is 500. So when you do your math, you get this figure. That's for year 1. Year 2, the initial recognition is the figure here. Effective rate, the 8% multiplying this. You bring your 500. Then you do your calculations. That's all. That's all for the convertibles. That's all. Any convertible is like this. Any convertible you will ever see on this planet is like this. I have another question here. Very detailed one. Question 2. Very detailed one. Okay. So when they give you a question, what you need to do is read the the requirement. Now the requirement is saying that A, what should the value of the liability element of the convertible loan note be at? So the liability element of the convertible, the liability element of the convertible, so meaning that it should be held under amortized cost. It should be held under amortized cost. And you know the amortized cost. So amortized cost. The amortized cost is this your initial value. That's your initial value. You have your interest, effective interest. Effective interest. Then we have your payment. Payment is actually the interest paid. Payment is actually the interest paid, right? You have your payment. So what is the initial value? Let's go to the question. Initial value. Convertible loan note. Liability company. Liability component. The question says that what should the value of the liability element of the convertible loan? The question is saying financial reporting is very simple and interesting. The question is saying that convertible loan note liability component is 28,508. That's the initial value. 28,508. Our effective interest rate. Where is the question? I. The convertible loan note are 8%, 30 million convertible loan note issued on 1st October 20x4 at par. An equivalent loan without the conversion will carry an interest rate of 10%. An equivalent loan without the conversion would carry an effective 10%. Remember in the previous question, I told you that this one is the interest payment, but the last interest that comes is the effective interest, which you will multiply with the initial value. So always the question, check for the last interest. The interest before the loan is the interest payment, but the interest at the end of the question is multiplied with the initial value or the initial recognition. So here it is 10%. So our 10% multiplying our initial value, we have this figure. Now we have our payment. I said it earlier on. Our payment is always the 8% times the 30 million. So our 8% multiplying 30,000. Trace the rows upwards. It's supposed to be negative. So negative, is it 8%? 8% multiplying 30,000. We have our negative 2,400. So your carry forward is this, the initial value plus the effective interest rate minus your payment. So this is your liability component. This figure here, your 28,958.80 or 28,959 to the nearest whole number is your liability component. That is your liability component. Your liability component is this. You know why this is your liability component? It's because the question says that what should the value of the liability element of the convertible loan note be at 30th September 20x5. 30th September 20x5. Convertible loan is 1st October 20x4. So only 1 year. So if they were to ask you that 30th September 20x6, if they were supposed to tell you that it is 20x6, so from 20x4 to 20x6 is how many years? 2 years. So you do it for the next year. You do it for the next year. So then your initial value will be the carry forward of the previous year. This figure, effective interest rate is your 10% multiplying your initial value. 10% multiplying your initial value. Your payment is always 2,400. The 8% multiplying your 30 million, 2,400. So do your additions. So this is the liability element in 20x6 if it is 2 years. If it is 3 years, the same thing downwards. 4 years, the same thing down. 100 years, the same thing downwards. Are you getting me? So that's all you need to know. So that's all about financial instruments, the financial liability and your convertibles. That's all. Your recognition, this, that's all. Now, the B said that part finance cost should be shown in the statement of profit or loss in respect of the loan note. 5% loan note, 10,000. So B, the loan note, the nominal value is 10,000. Nominal value is 10,000. Now let us read the question again. The loan note, the question is talking about your loan note, 5% loan note, note II. They have even shown it here, note II, note II. The 5% loan note were issued at par of 10 million. That's your nominal value. But Howard incurred 400,000 issue cost. Financial liabilities. Initial recognition of financial liabilities. The net proceeds of cash received, less any cost of issuing. Note II was issued at par, but Howard incurred 400,000 issue cost. Incurred what? 400,000 issue cost. Issue cost 400,000. So it will be 400, ignoring 3 zeros. So your 10,000 minus your 400,000, 9,600. Initial value or initial recognition. Now, the loan note have an effective interest rate of 8%. So, effective rate of 8%. So, your initial value 9,600 multiplying 8%. I have relaxed because it's very simple. The question is saying that finance cost will be shown in the profit or loss. So this figure will be shown in the profit or loss as finance cost when you are doing your P&L. Other operating expenses, finance cost 768. That's all. You are done. There's nothing more to do again. That's all. That's all. Financial asset is the opposite. They won't even give you financial asset. I haven't seen any question on financial asset since I started doing my ACCA. Let's do this final question. Then I will bring my lectures to an end. So you have your financial statement. This is a full financial statement, but I have cut the footnote or the portion. The footnote or the portion. I've cut it. So this portion is only for financial instrument, right? Financial instrument. So let us solve it. Let us solve it. This is a compound financial instrument having a debt and an equity component, and this must be quantified. Are you getting me? Convertible. The moment you see convertible, meaning there's equity and liability, so you have to split them using split accounting. Split them using split accounting. So as I said earlier on, I have done it before the previous once in our previous example. This example, I've done it. So what you need to do, you bring your years, 20x0. So year 1 will be 20x1, 20x2, 20x3, 3 years. Do you know what you will do? I've already showed you in the previous, just a recap of what we did previously. Just a recap, okay? So what you will need to bring is your cash flows. What you need to bring is your cash flows. So years, then you have your cash flows. And I told you that your cash flow is the interest rate, because at the end of every year you generate an interest. And here the convertible is 30,000, that's 30 million. So the 8%, 30 million. So your cash flow should be 8% of the 30 million. That's the interest you pay annually. So 8% of that 30,000 is 2,400. 2,400. Because at the end of year 1, this is the interest. At the end of year 2, the same interest. But at the end of year 3, you are not going to only receive the interest. You are going to receive the interest plus your nominal value of the 30 million. So the interest plus your 30,000. You get the 32,400. Discount factor. Discount factor of 10%. Because this 8%, we have used it or exhausted it for our cash flows. That's the interest we pay. So the effective interest will be your discount factor. So 0.91, 0.83, 0.75. You multiply them. To get your discounted cash flow. Your discounted cash flow. Now from the question, so you add them. Yeah, you add them. After adding them, this will become your liability discounted. So liability. Now from the question, we issued a 30 million. So that's a 30,000. So nominal 30,000. So our equity is supposed to be in the middle. Equity. The balancing figure 30,000 minus the discounted liability. That's your equity. That's all. That's all. Now, what you need to do is that the equity component will remain unremeasured on the statement of financial position. So the debt component is only carried at amortized cost. The equity, you do nothing about it. The equity of 1524, you do nothing about it. Are you getting me? So the only thing you do is that the debt component you add the debt component, you treat it under your amortized cost. I have taught you amortized cost. So amortized cost. And how do we do our amortized cost? How do we do it? How do we do it? Very simple, straightforward. So this equity will just go under equity and liabilities in the financial statement. That's where it belongs. So it will go there. So now we treat our debt component, this 28,477, as amortized cost. So what do we do? So balance brought forward or initial recognition, effective interest rate, interest paid, balance carry forward, right? Balance brought forward is what? The liability discounted. Effective interest rate is our 10%. Effective interest rate is our 10%. So our 10% multiplying our 10% multiplying our balance brought forward, our interest paid is our 2,400. That's our 8% multiplying our 30 million, 30,000. Supposed to be a negative figure. You do your calculations. So now here the effective interest rate will go into the statement of profit and loss as your finance cost. And now this one will go to non-current liabilities in the statement of financial position. This is your liability. Remember, this is your liability. So this will go into your statement of profit and loss and a non-current liability, because it's not a 1 year thing, it's more than a year. It is more than a year. So it will go into your non-current asset, non-current liabilities, and this is your finance cost. This is your finance cost. Remember, I didn't bring the requirement. The question says that the financial statement is going to be prepared in the following year. So here it is 20x0. So the financial statement is being prepared in 20x1. So if the financial statement was to be prepared in 20x2, meaning that 2 years, so you just bring the same workings down here. But since it's a 1 year thing, this will be your non-current liability in the statement of financial position, and this will be your finance cost in your profit and loss. So finance cost in P and L. That's all. That's all you need to know about financial instruments. That's convertibles and your financial liabilities. So if they give you only a financial liability, the only thing you need to do is your nominal value. If it is financial liability, then it's your nominal value less your transaction or less your cost of issuing. Then your subsequent, you measure it under amortized cost using the approach I have shared with you. So that's all you need to know about financial instruments. So I've tagged on the financial liability, the recognition and the treatment. And I have also tagged on convertibles. They are very simple. Very, very simple. So it doesn't take time. Thank you very much. Do not forget to subscribe.